Good day, ladies and gentlemen. I'm pleased to bring to you today a new series from EBnet Stream called Living Markets with Liberty, where we're going to be unpacking what's happening in our investment markets and how that is affecting retirement fund advisors, trustees, and their members. I'm Leon Greyling of EBnet Stream, and I'm pleased to be joined today by John Taylor, an actuary and an investment expert at Liberty Corporate Benefits. First of all, John, welcome. Thank you for joining us, and thank you very much to Liberty for your support in this series.
Thanks so much, Leon. It's fantastic to be with you today.
Great. John, when I first started working, I had an actuary who was a boss, but I'm going to say he was an actuary from the prior generation. He won't be so keen to hear that. He always used to say to me that he could guarantee that investment markets were going to go up and that they were going to go down. He could just never, ever tell me when and by how much. So I believe that the generation of actuaries these days, and by that I mean you, are actually able to tell us when and by how much. So on that note, please tell me what is happening in our markets.
Leon, I wish that my crystal ball was working that well. I think what we know is that given enough time, it'll go up, but it's that old adage of how long is long enough for me to guarantee that. But yeah, hopefully we can give some insights into what happens, particularly with a retirement fund perspective on these investments.
Yeah, sure. That's without a doubt. And I think it's so important for us to try to draw some parallels. I have another series called Power Plays and Paydays, where we talk about the politics and the impact on the economics in South Africa. And I just stand and I look and I see that we've had such poor economic results, yet our markets have done so well. I mean, probably 10% real returns, if not more, on our equity markets now over 5 years. I mean, that's phenomenal results that we've achieved. So from a savings perspective, it shows, first of all, the value of saving. But secondly, it's for some reason, there's a disconnect that I don't understand. And yesterday was a case in point. I was always taught that if interest rates go down, investment markets should go up. If that didn't happen, the markets went down. So I'm very, very confused. So, John, I'm really looking forward to having this chat with you. Just to give some clarity, some kind of perspective on what is happening at the moment. So on that note, can I ask you to perhaps talk a little bit about how the markets have been doing, what the latest is, and what we are perhaps expecting to see happen going forward?
Spot on. Thanks, Leon. I guess your comment around, classical economics teaching us that interest rates moving downwards should imply that prices go upwards. You're forgetting that small important word that our economics 1 lecturers would have said just before that sentence, which is ceteris paribus, all things equal. That's what's going to happen, and that's the problem. Is in the real world, all things aren't equal when we see these movements, and things like uncertainty around the US tariffs obviously played massively into market sentiment yesterday. Although keeping in mind that this isn't our first round of dealing with postponements and delays and implementations and the like of US tariffs. And we literally, as South Africans, were waiting until the last second to see, would we get a reprieve like Mexico did, or would we be on the list with India and other BRICS nations that would get the tariffs implemented on our exports. As things stand today, yes, there are additional tariffs of 30% being applied to South African exports into the United States. But by the time anyone watches this, who knows what the lay of the land is. And it's that uncertainty that is fundamentally driving a lot of your kind of risk-off behavior.
So what are the effective dates expected now in terms of the tariffs? So it's been confirmed at 30%, but what is the effective date for implementation?
1 August. So as we sit here today, American imports of South African goods, among other nations' goods, are going to have the increased tariffs applied. Mexico got another 90-day postponement on theirs, but yeah, the rest of us, less so.
So it's interesting. I was reading an article this morning where I'm not certain who to believe, but some people were saying that we were negotiating a trade deal. Others saying that we weren't in any kind of discussions whatsoever. So I'm not saying who's telling the truth on that. But the one thing that struck me in the article is apparently if there were negotiations taking place, that the US specifically raised the BEE legislation as part of those negotiations. So I'm not surprised that we ended up at an impasse in that respect.
Leon, I'm fully agreed. I mean, what we were doing or not doing, that I think will be a bit of a mystery for some time. What is very clear is that our transformation policies in South Africa have played a role in the US's decision, as well as our close association with the BRICS nation grouping, which we know they're not a fan of that power block.
So, I mean, the reality is it had some impact on our market. It'll be interesting to see now what happens going forward. There's no doubt it's going to, further hamper economic growth. It's definitely not positive for the unemployment picture. As I said, there's this disconnect between the economic stats and our markets, and it's not like it's a one-day disconnect. I mean, this is a long-term disconnect between JSE returns. The JSE has gone through the 100,000 level, historic highs. What do you think is driving that? I mean, why is there that disconnect? And are markets significantly overvalued or not, given that picture?
So it reminds me of where we were sort of 10 years ago, but in the opposite direction, in that for the period from the 2008 great financial crisis all the way through to call it the COVID crisis, and just a little bit beyond that, we lived through a period of zero interest rate policies, negative interest rate policies in many parts of the world, which resulted in lots of cheap, easy money floating in the system. And that drove that very odd behavior that good news was bad news because it implied stimulus might come off, whereas good news, the other way around, bad news became good news because that implied that there'd be more stimulus put onto the table. We've now obviously gone through the pain, and one wonders where that might leave us still around interest rates moving up very rapidly in 2022 all the way through to call it 2024. We've seen interest rates starting to moderate. We had an interest rate decrease at the end of July now in South Africa. One wonders what happens in the US because Jerome Powell has obviously indicated that there's still very strong US data, which implies he doesn't have to cut rates. And obviously President Trump implying, among other things, that would be the wrong decision to make. And we have this animosity building between national treasuries and central banks around the world. I mean, obviously the US is a very direct, very aggressive way of seeing that. But even if you look in South Africa, at least you see some alignment, but it's very clear that our national treasury still favors a little bit of a more dovish interest rate policy, whereas it's very clear that our Monetary Policy Committee are very hawkish. And I think we must be very grateful that we got an interest rate cut at the end of July.
But I mean, that's interesting in terms of the dynamics between the two, and maybe for the sake of understanding for our audience, that if the US don't cut interest rates and we continue to cut interest rates, our bonds become less attractive.
Yes.
From an interest rate perspective, and therefore less flows into the country. So while there's a lot of domestic opportunity to further cut rates, given that inflation is holding it at a strong level and so on, a lot of it's now going to start depending on what does happen globally from that perspective. So there's a lot of pressure, yes, from Trump. He doesn't seem to like his Mr. Powell too much, but it'll be interesting to see what happens on that front and then how that impacts us ultimately.
Leon, that also is driving a lot of this dollar weakness that we're seeing. So I think anyone watching would have noticed that the rand looks incredibly strong compared to the US dollar. It's probably more the opposite. It's that the US dollar has weakened against a lot of currencies, and that is a stated policy objective that the Trump administration wants, and it's one that they're getting right. That obviously is in an attempt to make their exports more attractive. It also makes imports further less attractive on top of the tariffs that obviously they're building into the system. And you're spot on. In the absence of any other things changing, if that gap between South African interest rates and American interest rates narrows, you'll see more money flowing back into the United States, which is still perceived as a risk-free or certainly a less risky asset than in emerging markets. And again, that's something that South Africa has benefited from the tailwinds of that carry trade, which is that trade that says, I can't afford to live on those negative and zero real interest rates in the US and in Europe. I better find somewhere in emerging markets to put my money. And that trade is withering away. And as South Africa, we need to find more incentives in simply carry trade to encourage portfolio flows into South Africa.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally, for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
So if you look at the 5-year picture on the JSE, I think my numbers might be slightly off, but it's about 16% annualized for the past 5 years, so 16 to 17% annualized. So if you look at that compound, that's doubling of your value. Have earnings kept up, or are the markets just exceptionally expensive, or are the future expectations of earnings so high that it justifies these kind of levels? Because it's not coming through in the GDP numbers. So should we be afraid?
I think we should be cautious. Remember, we're coming off a base 5 years ago where South African shares were inordinately cheap compared to US and other developed market shares. And if you think of how hard, particularly technology shares, have run over the last 5 years, even the last year was tepid relative to the 4 years before that, but nonetheless, I mean, it's eye-watering. I don't think it's a case that South African shares are very expensive. I just think that that gap between US and South African shares, for example, has narrowed, so that uh, kind of moat of safety almost that you had on South African shares, that how much cheaper could they get, that isn't as apparent as it once was, and you do have some of our sectors. If you think resources, how hard the gold miners and the platinum miners have been running, which are starting to look quite pricey.
So the gold price has been phenomenal. So that's definitely an area of strength that we've seen. What are there any standout segments within the South African markets that have outstripped the others, or has it been pretty much across the board?
More recently, it's been pretty much across the board. I mean, we've gone through phases where you kind of see the resources run ahead of financials and industrials, and then it flips around. But in general, over the last 3 or 5 years, it's actually been pretty broad-based where you've seen the growth. I think that obviously in 2024, there was a very strong good news story around South African incorporated stocks of companies that drive a lot of their earnings out of their South African operations. And that's not a story we've had for a very long time. And you saw some of those kind of home brands in your shopping, kind of your retailers, your financials, really drive a bit of a boost. And I guess a lot of the GNU news last year drove that. And this year we've seen, some of the cautions around the GNU come to the fore, because it's not exactly the easiest marriage that these political parties are living in. And that's the reality of coalition politics everywhere in the world. But that being said, it still means that the JSE is sitting, as you say, at record highs.
And the rand yesterday went through the 18 level. I think it finished 18.19 or 18.20 or something like that. That, I'm assuming, was a combination of tariffs, interest rate cuts, and so on. But I suppose we can expect some rand weakness now going forward. So hedging your bets, so to speak, between diversification, local, offshore, is obviously key within markets like this.
Agreed. I think you've seen the rand take a bit of a breather after a nice long run, as I said, largely on the back of dollar weakness. And you're right, all of the news flow last year, yesterday, would have spoken to the rand weakening. As you say, interest rates moving downwards relative to other markets, as well as the trade tariffs. But that being said, I don't think that there's any reason to believe that the rand is expected to blow out unless there's significant South African factors or significant risk off trade for some reason comes to the fore. As I said, the US has a significant policy that they are trying to drive dollar weakness. We should keep that in mind in terms of positioning our portfolios going forward.
And in terms of South African asset managers, I think there's largely still risk on. Am I right? I mean, they're still fairly full weighted in terms of equity markets.
Yes, correct. And I think it's off the back that obviously with a forward-looking view that in its base case suggests interest rates are dropping off, then you're not going to favor income assets too much or as much going forward. Although I think there is some caution built into the fact that the old adage that global exposure, particularly in a pension fund environment, that just doesn't hold true anymore. You do need to apply your mind to the underlying fundamentals in the asset classes that you're accessing.
So you give advice to pension funds. I mean, like, maybe sum up in your mind right now when you're in front of a board of trustees. What are you saying to them, and is there anything different you're saying right now compared to perhaps what you would have been saying last year or the year before?
Fundamentally, Leon, no. The rules of the game haven't changed. The actual lay of the land looks a bit different in a different terrain, but the reality for a pension fund and a board of trustees making decisions, for example, is that the rules around strategic asset allocation haven't changed. And that is still the case. Research done in the 1990s suggests that the variance in returns is more than 90%. I think the number was 93% driven out of strategic asset allocation. So it's fundamentally important when we're engaging with clients to get them to, I mean, you need to notice the signal that's coming through, but you mustn't be distracted by noise in that signal. So as much as things like tariffs and interest rate movements are important signals, it doesn't break the laws of economics. And we need to think through these kind of logical steps that they take. So I'm continually trying to remind boards of trustees and management committees of the fact that their duty is really to think through the long-term strategic asset allocation and whether that's still a fit for an inflation plus 2, 3, 4, 5 environment, depending on what the objectives look like.
I'm actually going to segue a little bit there because you just said something that piqued my interest. You mentioned boards of trustees and management committees. Okay, so are you talking about those invested in umbrella funds who have some form of oversight? And I actually just wrote a paper or an article yesterday on the role and responsibility of management committees, because what I've seen a lot happening in the market is it's almost like, oh, we're going into an umbrella fund, therefore no need to worry. We don't need to be trained. We don't need to really apply ourselves that much. And that to me is not my understanding of a management committee. And with Kofi coming to the fore as well, at whenever that might be, it's going to become more formalized in terms of the role of the management committee. So just speak to me a little bit about that. I mean, like, you view a management committee versus a board in the advice that you give, same, similar?
Yes, I think that in terms of your responsibility towards the employees or the members on the fund, I don't think that there's a reason to think of it too differently. Obviously, the legal obligations put on them differ quite fundamentally, but that doesn't mean that I think the fiduciary duty and the concepts around care towards these employees change at all. So, as a management committee, I think it's incumbent on those member representatives and the employee representatives to make sure, is this a fit for the employees? Is it demonstrating the required level of care that we would want to show to these people? I was saying yesterday to a group of people, working in insurance and in in the financial sector is already such a privileged position to be in, but working in employee benefits takes it one step higher. You're dealing with somebody else's money, and you're dealing with that family's money. I don't think that we can at all divorce the fact that management committees have a strong obligation to consider their fiduciary duties, even if it isn't codified into law in quite the way we would want it to be yet.
Cool. You're going to love my article, and so I'll make sure to send it to you. We mentioned gold a little bit earlier has become a bit of a safe haven with all of the, call it, uncertainty that's been going around with tariffs and all the rest. The other one, interestingly, has been crypto, and that crypto suddenly becomes seen as a safe haven, which if you spoke to my parents, they would think you just lost your mind, because that's got to be the riskiest thing in the world. I'm still not sure, even though I've started dabbling there, thinking maybe I need to, modernize my thinking. Why is crypto now suddenly being seen as a place of security?
I think it's partly the draw card is just how phenomenally well some of the bigger crypto coins have done. I mean, the obvious ubiquitous one is Bitcoin, which has, it's phenomenal, the levels. And again, we're getting to those eye-watering stories where people say, can we reach $1 million? The fundamental thing here is, one of the key drivers around crypto was this concept of decoupling from regulated markets and regulated kind of central banks and the like. And what is it that people are, again, scared of, wary of, cautious about? Central banks, the influence of governments, etc., etc. So I don't think it's surprising that would then see people viewing crypto assets as an alternative store of wealth. I'm also a bit of a cautious user. Not something that I like to play too much in, but you're right. I think we can't ignore it. We can't pretend that it's an alternative kind of niche space anymore. It's rapidly moving into the mainstream. And as stakeholders in the pension funds space, we need to keep a very close eye on developments in that sector and in the regulation thereof.
So, coming to wrap up for today's session, because our time is nearly up, but I would actually encourage those of you, I'm no longer in the asset consulting, investment consulting, or investment management space directly, but I would encourage investment consultants to start paying more attention, and only from the perspective of that, call it, decoupling or diversification effect that is there. In fact, I would encourage investment managers to start thinking carefully about it and actually start analyzing it better. Why do I say that? Because from what you've said, your advice to customers right now is don't panic. You're long-term investors. Stick to your strategy. That's why nothing's changed in that advice ever. And it's been good advice because the markets have ultimately proven that that's how to go about making long-term investments for the benefit of members. So stick to your strategy. Make sure your strategy is correct and matching your liabilities appropriately. And don't make the mistake of reacting to short-termism. That's what I can bet is your best advice. Now, in that context, finding diversified investments to smooth the ride is important because it takes the psychology out of the decision making. Never 100%, but it helps manage the psychology of the investors. I'm going to test your age here. I don't know if I can't say, do you remember? Do you know that back in the 80s and 90s, there used to be a survey called the Consulting Actuary Survey?
Yes,
Right.
I've heard about it. Yeah.
So what we used to do, now I'm giving my age away, is we used to survey pension funds. So we would actually go to the pension funds and we would collect all of the data on the pension fund and how the pension fund performed. within certain risk categories and so on. And at the same time, we started creating the manager watch type surveys where you surveyed the managers. Which one do you think outperformed the other?
I have a sneaky feeling that the manager watch I would have outperformed what the pension funds were reporting.
100% right. 100% right. To the point that the pension funds started getting upset with the survey and no longer wanted to participate. And it just shows you that we make decisions poorly because we make decisions on the wrong basis. So sticking to the strategy, rather question your strategy than the implementation thereof.
Yeah, no, spot on. Absolutely right.
Right. Well, good. John, thank you very much. And again, thank you to Liberty Corporate Benefits for supporting this series. I'm looking forward to having this monthly interaction and digging in a little bit to help our audience understand the context of what's going on within our markets and ultimately to relate it back to the decision making. I think that's an important role that we can fulfill through these discussions. So on that note, thank you very much. Thank you for joining us, and we will see you in a month's time.
Thanks, Leon.
All the best.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.